Welcome to Accounting Expo. Today we shall be looking at accounting concepts and conventions. Like we all know, the major aspect of accounting is everything will be used, every books of account prepared will be used to prepare financial statements. And the financial statement that is being prepared and communicated to interested parties will be used to make decision. So for decision making by different users to be objective, there is need for rules and guidelines in the preparation of financial statements. So accounting concept is a concept in accounting that guides the concept that contains the rules, guidelines and the laws guiding the preparation of financial statements. Now the various types of accounting concepts are business entity concepts, going concern concept, dual aspect concept, historical cost concept, money measurement concept, periodicity concept, accrual concept, matching concept and realization concepts. Business entity concept is a concept in accounting that assumes that ownership is different from the business enterprises. That is, the person that owns the organization is different from the business organization. Going concern concept states that the business will continue trading into the nearest future and is not at the verge of cessation. That is, even when the owner dies, the business will be in continuous operation. Dual aspect concept is a concept that assumes that there are two aspects involved in every transaction, and it is based on this dual aspect concept that the principle, the rule of double entry that says that for every debit entry there must be a corresponding credit entry, vice versa, comes from. The next accounting concept we are looking at is the historical cost concept. Historical cost concept says that assets are valued at the cost of the acquisition and not at the market value, and that is why whenever there is depreciation, the cost is shown, the accumulated depreciation is shown before the net book value as at that period of time. So the value of acquisition includes the cost of carrying the asset and also the cost of erecting the assets. Now the next one is money measurement concept. Money measurement concept says that in the preparation of financial statements, next concept is money measurement concept, which says that as items that are shown in the financial statements must be determined monetarily, that is in the unit of money. For instance, in Nigeria we use naira as our currency, then Ghana cedi, USA dollars and so on and so forth. Periodicity concept states that the financial statements are divided into a period of time. You know, as earlier on we said that going concern concept says that the business organization will continue trading for an indefinitely long period of time. So those period of time, while preparing the statement of accounts, they are divided into different periods while determining the profitability of the business concerned. Matching concept says that in the determination of profits, all expenses for that year are matched together with the revenue for that year, irrespective of the fact that money has been paid or revenue are yet to be paid. The realization concept says that revenue is considered to be earned whenever goods or services have been rendered to the customers and the customer agrees to pay for it. Now we go to accounting convention. Accounting convention are the guidelines, customs that are used to solve conflicts arising from the application of the accounting concepts while making entries into the financial statement. The first convention we are looking at is the prudence or conservatism convention, which says that expenses are provided for, whereas incomes are underestimated. Now, I said revenue in realization concepts. Revenue is considered to be earned whenever goods have been dispatched to the customers and incurs liability for it. But in a bid to underestimate revenue, there is need to make provision for possible bad debts. Or conservatism convention says that losses are to be anticipated for, but possible expense revenue should be ignored. In the books of accounts, with consistency convention says that over the years a method should be applied. For instance, if the organization applies straight line method, it should continue to apply that straight line method throughout the useful life of the asset. You should not use straight line today this year, reducing balance method next year, so that there will be room for comparison. Materiality convention says that only items of material value should be used while making entries into books of account. Objectivity convention says that the true and fair position of the state of the books of account should be presented, and it should not be subjected to the biased opinion of the person preparing it. Having gotten to this stage, I want to say thank you for your time and God bless you.